Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, happy to be back with you again today. I'm your host, Dr. Allen. With us today is a veteran real estate developer and entrepreneur, a third-generation Southern Californian who is making it big in a state where many real estate developers are fleeing. The wisdom he brings from success in a market where many others have failed is invaluable. Whether you are new or tuning in for the first time to the show, I know you're going to find great value in the show today. As busy professionals fulfilled in the work of our calling, it is likely that our major source of income comes from the work of our passion. Like most professionals in our situation, we will be financially devastated if for any reason the income generated from immersion in our calling were to be cut off. Even though passionate about our work, the reality is that we are exchanging time and effort for money. As long as we continue to exchange our labor and our time for money, we live with the insecurity of knowing that our stream of income could come to an end at any moment. The loss could be due to a family member in need of our care, we ourselves could become ill and unable to work, or hundreds of other issues could arise that result in the loss of that major stream of income. Such insecurities are not imaginary, as that very thing happened to me and I wasn't prepared. If I'd known 20 years ago what I know today, the financial hardships experienced because of that loss could have been prevented. I established the Talker Capital for the professionals like you so you can develop financial streams of income that are not dependent upon exchanging your time and effort for money. Go to our website, steedtalker.com, get your concise one-page guide to the 10 proven steps to profitable passive real estate investing. With us today is Scott Choppin, who founded the Urban Pacific Group of Companies in 2000. Since then, his company has brought over 1,700 units of affordable housing to communities throughout the Southwest. Scott, before we get into the business of real estate, tell us about an experience from your formative years that helped you to be the person you are today.
Before we started the interview proper, we talked about what does formative mean, and we both said, hey, it's like ongoing. So I'm going to pull from a vast well of learning formative experiences. I think the one that I would think about really is sort of, I'm not sure if you and I have ever talked about this, but when I was young, like 18 or 19, I wasn't clear on what my career was going to be. I didn't know at that point that I was going to be a real estate developer. I had a family background in that. And I actually worked in the electrical trades, like worked construction daily for at least 2 years, maybe longer, maybe 3 or 4 years. I can't remember exactly. It's a long time ago now. But I realized that like working a job that like ultimately I figured out I didn't like really was helpful for me to one of those things that to learn what not to do. But also it was interesting because working in the construction sites, I actually worked on predominantly, this is in the early 80s in Southern California. I worked on all new construction apartment buildings. Now, there was a reason for that. My dad and my Uncle Mike were both in the real estate development space, and my dad actually helped me get the job in the trades. Like I wasn't sure what I was going to do. And so working that job, physical, and being an electrician is actually one of the better trades that you could pick because you get to use your brain and some math skills, and it's not digging ditches and heavy lifting.
Yeah, it's not like plumbing where your hands are dirty all the time.
Right. You do get dirty. It's like relative compared to what working that in that physical labor environment really taught me what I didn't want to do. But I also got to observe the other side of it, meaning what does the developer do? And I remember it was funny because one day the developer of this job site I was working on, it wasn't nobody related to anybody I knew. I didn't even know the guy's name, but I could tell who this person was. They drove a nice car, wore the suit and tie on those back in those days when we used to do that. I probably created the story in my head, pointed at some stuff and told some people what to do, but like he was the man. Yeah. And the formative experience was I had the great fortune because of my family background, plus some studying I had done of my own in the real estate investment space at the time. I knew who that guy was. I knew what they did. I knew the idea behind buy a piece of land, build a new building, rent units, own it, sell it if that's what you're going to do. And so it's sort of the singularity. And it was like at that point in time, I go, oh, this is what I'm going to do. And I made that. That was the time in my life where I made the choice. And I was only 18 or 19. So I feel very fortunate that I was able to do it that early. And because I had the background and had done reading. So that really coalesced for me in the context of basically what ultimately became, I've got no more construction, get a college degree, go work for one or more professional real estate development companies. So probably about a 4 or 5 year additional arc of effort before I even worked in the industry, meaning to get a college degree, go to work for, actually ended up being about 4.5, 5 years that I worked it professionally. It's probably was way less magical than I think of it in my head, but I think it's those kind of experiences that inform you that what not to do, tried this, not afraid to experiment. And I had to make, and I was one of those guys that left home at, 17 and a half and launched into the world and had like a car and some clothes. And I was like, so I had to make money. So there's that. I think it was one of those sort of series of steps that you find out where the right path seems to be. And I would offer, don't be afraid to search around the people that are around you, whether it be family, friends, people to investigate what might be a potential career source. Don't dismiss it. Some people go, oh, my family did that, so I won't do that. And I think there's a loss of families and parents and family friends have a lot of knowledge that you as a kid don't necessarily pick up on. Maybe you ignore it purposely. Maybe you don't know it's there. Maybe you don't recognize it, but it's such a powerful thing. And our culture, the idea of getting kicked out of the house at 18 and go make your way, son or daughter, and maybe that's not so much today, but that's a real loss of institutional knowledge of your family and your family's friends and people that are connected with you through those networks. Pay attention to that. That could be a serious value to you in your future.
Absolutely. And I think it's interesting. A lot of times, some of our best learning experiences are doing things that we don't want to do and are not enjoying. Unfortunately, a lot of people think that they're stuck with that and they don't move out of that. But you had the good sense and you looked around and you said, this isn't what I want to do, but there is a direction I want to go. I think you're fortunate too in finding it at a young age. Not all of us have been that fortunate.
Yeah, I agree. I appreciate it. Thank you.
You bet. There's one thing that fascinates me about you, and that is that you have found a place in Southern California. Southern California is a beautiful place. I actually love it. The climate is beautiful down there and a lot of beautiful things down there. However, there's a lot of population congestion. There's a high cost of living, and a lot of people are fleeing the state, particularly investors and developers, because of all of those factors, plus the fact that there just seems to be more and more regulation and hurdles to jump in terms of the development. And yet you started your company 20 years ago, and you have been very successful in bringing particularly workforce housing to the market. And in fact, you've been able to, on average, return about a 29% internal rate of return to your investors. Tell us your secret to success in a place where many people are fleeing.
It's funny, the great question. I appreciate it. I actually just had this conversation yesterday with somebody. And the idea that how I think of California now is sort of in the old Warren Buffett model of buying businesses or investing in businesses that have what he calls a moat, right? Like a protective mechanism, a moat being a water protection. But it could be anything. It could be IP, it could be technology, it could be location, it could be expertise, knowledge, patents. And so I think of California that way. And so I've spent my entire career here. I'm actually third generation. My kids are fourth generation here in the city of Long Beach, where we're headquartered and where we live. So I have spent my entire career, and I've worked, in several other states, in Texas and Colorado and Oregon. California, although has been the primary part of my career. And so I came up through the ranks of companies in the development business, learning all the component parts of what a real estate developer has to do, and created, as you suggested, our what we call the urban townhouse model, or UTH model, is a offer that is really, it's California centric, although it can work in other markets outside of California, in major urban metro areas. But the capability to execute inside of California becomes itself a protective mechanism, right? Because many people, as you say, they're leaving California. If you're an investor, you're going to look in the Midwest and the Rust Belt. California is too expensive. And they're right. We talked before about the people who are thinking about getting in the real estate development business as a reaction to finding properties that are in high demand markets that aren't overpriced or have low availability of properties if you're investing in multifamily assets. That's such a common theme. And so it gets people thinking about, hey, maybe I need to go try my hand at real estate development. And so we basically created this model, but because we knew California so well, and also the regulatory environment that you described, the politics of zoning and housing growth are awful. California is like the hands down worst place, worse than New York and New Jersey. Like anybody who's from those markets would know. We have the regulatory environment, plus we have the anti-growth, anti-development political environment, right? NIMBY, not in my backyards, like being one of the sort of examples of that. Once you figure it out, though, if you can make it work, and then everybody else wants to stay out of that market. And I'm not sitting here saying we're never going to have competition. We will. We need to design for that. But we have an interesting space to grow our workforce housing model in. And so I think it really comes from knowledge, right? To answer your question, what's the secret of it? I think a lot of people that I see look at California as a bad place to do business, at least in the context of real estate development, probably don't understand it as thorough as we do. We can only do what we do because we're so deeply ingrained in the California style of real estate development that we have to, or that we can be operative in that space. But I also offer, there's many things about the California market and the political environment where we make specific choices. So it's not just the knowledge of how to be a real estate developer, but what we also combine that with is choices of how we do it. So an example would be zoning, and changing zoning on a property in California is a pretty tall order, right? You get planning commission, city council, neighbors who want to fight you, and every project has neighbors that want to fight you in California, and I think in many markets. We choose not to buy sites that require zoning. So we skip that process. So we go, we know it really well, and we've done that a lot. And therefore, in this instance, to reduce complexity and increase efficiency and profitability, we skip that step. Now, it's hard to find properties that have perfect zoning. So people go, that's hard to find. It is hard to find. I will agree with you. But we've been able to, through our networks of brokers and our own systems of finding land, been able to produce a very robust pipeline of projects. So those are the kind of examples. So though there's some things that you don't do within that environment that are inherently there, and you just go, look, I'm going to bypass that. And there's several other things that are conducive to that. And then I'll end it with this: we continue to need to be vigilant. So the regulatory environment, California is the most aggressive in all regulatory levels and layers. We dodged a bullet last year. There was a referendum on this for a vote for the state in November to bring in a much more highly regulated rent control, right? It sort of would take an old law that resisted rent control, that would eliminate that, allowing cities then to increase the level of regulatory involvement, and then allow cities even to invoke rent control when they didn't have it. And we're in the midst of that environment, right, where rent control becomes a common theme of conversations, which is when housing prices get really high. That's when, people go, hey, look, I'm being priced out of the market, and therefore we need to have price caps. And rent control is basically a price cap when you look at it from economic terms, which is usually a bad signal generally, right? When you have to resort to government cost control for a market, usually means the market's not working. And certainly we would say that to be the case about California. So I know that was a long answer, and I think there's several parts of that, but I would just end with this: anybody can produce the sort of competitive advantages that we have produced. I designed this product, UTH, to meet these different criteria. And also, I didn't talk about it yet, but to also compete our housing in a high demand, low supply marketplace. Again, another fundamental economic principle. So it's 8 or 10 different things that we're looking, how we choose land and where we choose it and what market we identify to build to and the type of capital and finance that we use. So it all comes together in this space where we go, okay, it works. We can produce these returns that you talked about. Now, you did say 29. Actually, our latest update is we're 23.04 on the portfolio that we've completed and sold. And then we're actually in the midst right now, I'm going to release publicly a offer for a new equity fund. We're calling it Urban Pacific Workforce Housing Fund 1, which will be an institutional private real estate equity fund that will then become a significant source of capital for us. So that's, again, another one of those moves to pair multiple things together to try to make the overall business model work successfully.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
You said that you skip zoning, but in actuality, you're just living within zoning and you're finding properties that are already zoned the way that you want them to be. And yet one of your focuses is that you do infill. So you are not going out to the far extremes of the suburbs finding these properties. You're actually doing infill within inner cities and within the inner suburbs. Is that not correct?
That's exactly. Yeah, you're right. We don't skip zoning. We live within the existing zoning that works for our product type, UT8. And we call that buy. So in other words, you can go ahead and submit your plans for plan check buy without any zoning or planning commission or city council oversight. It's approved I don't want to say in theory, if you fit within the envelope of the zoning, then you go ahead, you're approved to move to the next step. So that's right. And then infill, yeah, you're exactly right. And in fact, I would even, since we talked last, we are actually completely focused on a particular sub-sector of the suburban marketplace, what we're calling urbanized suburbs. And what that means is it's a suburban city or location or geography within a larger urban metro. So for us, it's Los Angeles and Orange counties where we're most active right now in our UTH model. But we're not in the city center. Our early years of Urban Pacific, we were doing the downtown LA, downtown Long Beach, really high density stuff. And so UTH, another one of those tactics that we use to shift the model to a different marketplace, is that we were developing townhouse style rental units in a urbanized suburban environment going back. We started that about 5 years ago, right? If I do the math, that's 4.5, 5 years ago. And that predated, of course, as people do the math, we're in 2021 when we had this interview. It predated the pandemic of 2020. Well, interestingly enough, the pandemic accelerated that move from really central business district urban into the urbanized suburbs. Now, in the mainstream media, they're all like, oh, everybody's leaving the city and they're going to the country, or they're going to rural. But the stats don't support that. Really, what the stats support is people are moving out of the city center about an hour or two away max. And usually that ends them up in an urbanized suburb. So if you're in San Francisco, you move to Oakland or the East Bay, like you're an hour away from the city if that's where you happen to live. And so if you look at a map, you got San Francisco here. Well, all the counties around San Francisco, Marin, Contra Costa, Alameda, Santa Clara, San Mateo, that people were spreading out that way, but really not going much further, maybe a little bit to Sacramento. And then in one study, there's this narrative about everybody's leaving Dakota, Arizona, Texas, Washington, if you're in California. But it's actually in the study they did, a very small component, like out of 100 people, I'm making these numbers up, but something like this, 100 people, 2 of them left San Francisco to move to Austin. And 98 of them stayed. Maybe 2 or 3 more went to other states that weren't Texas. And then like 90 of them stayed in California, just moved away from the city of San Francisco and went to outlying urbanized suburbs. And this is a really important thing to think about, because basically, that's where the work from home market has now expanded. People are going to work from home. They're looking for these suburban locations. They still need amenities. They still need fun stuff to do and music to go listen to and restaurants to entertain themselves at. They're not moving to farmland in the middle of Iowa and being isolated from everybody. And the report I'm describing was done by Zillow. So yeah, definitely.
You have talked about the UTA, which is your urban townhouse, but your urban townhouses have something special about them that most other urban houses do not have, which is that they're really built for blended houses, either parents with their children or children living with their parents or so on and so forth. So tell us a little bit about the design of those and why those have been so successful.
Yeah, no, I appreciate that question. So UTH stands for urban townhouse, just like you said, and UTH is a 5-bedroom, 4-bathroom, 3-story townhouse unit, right? Like we have a standardized unit that we, design, lay a site out with multiple of these same type of unit, basically a plan, we might call it. And basically the 5-bedroom, 4 bathrooms, it serves multi-generational family groups that usually are related but living 2 or more generations under the same rooftop. So grandparents, parents, maybe adult kids, and then small kids of either parents or the adult children. And one of the bathrooms that we build is always on the ground floor. So that can be for an in-law or a grandparent that might have mobility issues, so that the grandparents can live with the family. And then we do the 3-story townhouse because it's really, the way we describe it is designed to build to rent, but lives like a house. And in fact, there's a market that's been basically growing and becoming like a mainstream topic in the media, both in the real estate media and the general media, of this market called built to rent or build to rent or single family rental, some people call it. And those are all interchangeable. And we're our version of build to rent, meaning we build a townhouse that normally in California would be a for sale condo unit that a family or somebody would buy and own and live in. We just happen to build that same physical format of the 3-story townhouse, but we own it for the long run, and then we rent it to these multi-generational families. Now, since we talked last, one of the markets that's accelerated in a very big way is the work from home environment, the work from home space as an offer. And so one of the things that these people that are moving out of the city center into these urbanized suburbs is that they're really looking for a different kind of space. They're looking to get out of the small unit. They're looking maybe to share with roommates, right? Professional roommates. But they're really looking for extra bedrooms, bigger units. Our units happen to have a 2-car garage, like a private garage, like you would have at your house, in-unit laundry room. So we didn't necessarily design for the pandemic and the work from home environment, but that has accelerated tremendously. Now our focus ethically and philosophically is on multi-generational families that practice economic sharing. And what that means is that they'll have several, let's say for a family, you might have 2 or 3 or 4 income earners, right? We call it a multi-earner household, which basically gives this family a capability to do 2 things. One is to afford better housing at a lesser rate of their income, again, as using to pay for the housing, but also it gives them a unique resilience, right? So particularly we've seen this in the pandemic. We saw it in the 2008 recession, that when an economic downturn strikes, these families, because they have several, in some cases, income earners, they're much more capable of taking layoffs or unemployment in stride because they have more than one income source, right? In the investment world, it'd be multiple sources of income. It just happens to be these are predominantly W-2 employees, although I will say in one of our recent projects, we have several families that are like really at the core entrepreneurial. Mom owns a business and 2 daughters and a grandmother live with them. The daughters are in school or working. Grandmother's at home. Mom produces the majority of the income. But they decided to come together in our unit and share housing. Like I think in this case, the mom and the 2 daughters live together already, but they brought the grandmother in with them. So they're all related. Like we don't rent to families that are like not related, like just 2 disparate, separate families. But what we do find is we allow families to recombine, is the terminology I use, which is to bring an in-law or bring a grandparent, or maybe an adult child moves home, boomerang child or adult child, and they're coming together in this format under one rooftop where that they have a garage, they have in laundry, everybody has their own bedrooms, and 4 bathrooms, by the way, is a big deal. And anybody who's got kids and family, bathrooms are actually usually the constraining resource in a house. And so we're really enthusiastic to be able to provide that. And so what all that basically means, in a really fundamental way to answer your question, is our units allow people to practice economic sharing, to be resilient in high cost markets and resilient in downturns, because they have these multiple earners coming together. And basically we've had a tremendous, through the pandemic in 2020 and 2021, we actually are leasing a project right now in the city of Montebello, and it's at the fastest pace of leasing that I've ever had in my entire career, and somewhere between 300 to 500 a month over our original pro forma rents, which in this environment, as a multifamily owner, developer, investor, like that's an incredible statistic to be able to share with you and your audience. We're super grateful about it. We couldn't have anticipated that the pandemic would necessarily accelerate that, although usually those kind of things do accelerate some things and destroy others, right? Like in the instance of economic or just general change in the marketplace. So yeah, we're super enthusiastic about how it's going right now.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. Fascinating model, and it clearly is working not just for you in terms of profitability, but it is obviously filling a place in the marketplace where there is clearly a demand. Let's turn this to the passive investor, since that is primarily who our viewers and listeners are. And you had talked briefly about you are establishing a fund. So let's begin there. Mm-hmm. Tell us about the fund and tell us how our passive investors can become a part of that fund.
Sure. Yeah. It's an institutional fund. So the intention is to raise capital from institutional capital sources, family offices, and other larger institutions. It's a $50 million real estate equity fund called the Pacific Workforce Housing Fund 1. Certainly people, if they are interested to find out more, can get a hold of me through our website. My contact information is on our contact page at www.urbanpacific.com. And then there's actually a page on there called For Investors. And if you click on that For Investors menu item on the website, it actually have a form you can fill out. Tell us a little bit about your income information. Obviously, we're open to accredited investors only. And then Serena Overhoff is on our team, would be the person that you would speak to once you fill out that form. So the intention is to raise $50 million to produce somewhere between 12 and 16 separate assets that are all going to be in this UTH model. So everything is geared to produce more volume and larger projects, but exclusively in this workforce housing, multi-generational space. We're going to focus on Southern California initially, but if we're expecting to have good traction right now, workforce housing and affordability is at the top of everybody's mind because of the pandemic. People have been put in situations of underemployment or unemployment. Eviction moratorium is obviously on everybody's mind. And there's going to be some feedback and echo from when those evictions do come back, which, by the way, we don't look forward to that. That's a tough situation for everybody. I think the eviction moratoriums seem to be working okay, although I know I have several colleagues professionally who have apartments where it's a serious impact on cash flow and even just general viability of the deal. So there's that. And we need to we're short of housing across the U.S. We don't need less housing. We need more housing. So that would be a way that people could get a hold of us, basically to be a 5-year life cycle of the fund. We'll develop and hold these UTH projects. And almost all of right now we have 8 projects identified with another 6 projects that are teed up, meaning available in the marketplace, ready to develop. Once the fund gets its first closing, we'll start to move forward on those. But people can definitely get a hold of us through the website under the For Investors page at www.urbanpacific.com.
There's some great advantages to this. What is the minimum investment?
So the minimum investment on this fund, because it's institutional, is $1 million minimum
Okay.
investment.
So that's not going to be for your average investor. Do you
Right.
have opportunities for $50,000 investment?
We're right now, as we put the final component parts of the fund together, which is basically like we're launching now. That's why I'm able to share it with you. We're starting to think about there's going to be sectors of the marketplace that the fund will not look at either geographically, say San Diego or the Bay Area. And then also, I think there'll be some consideration for smaller projects. We traditionally, historically, have always done larger projects. Like as a developer, that's just where you gravitate. But as you and I spoke about last year was when we took on and developed the UTH innovation, we specifically started small in the early life cycle of that the offer to basically test the model. It was so different, really experimental. It's got the experimental sign on it. And we wanted to make sure it worked. But one interesting thing, and those all were very successful. We're actually developing several small assets as we speak right now that will not be in the fund. So the idea is that we're going to see if we either we'll joint venture with other people to keep it separate from the fund, or at least we're just like designing in our minds the idea of how to continue this small property space. We haven't ruled it in or out at this point in time, but that would certainly be in the future opportunities for smaller investors. It would be a fit for those size of investments that you're talking about.
And a lot of existing multifamily investing. Investors are investing not just for the internal rate of return, but they're also investing for cash flow. In developmental projects, cash flow is not going to be a component in that particular investment. So why would someone go with development rather than going with existing multifamily?
I'm generally in agreement with what you said, Alan, although I might just for your consideration, think of it a different way. Our assets actually do cash flow. In fact, we're generally throwing off between 6 and 8% cash on cash annually once we're stabilized. And this is the key. You're correct, because there's basically, let's say it takes 1 to 3 years to develop the asset. You won't have cash flow. In fact, you'll have cash flow out. You're investing. Right. And I think that's a key differentiator between development and standard acquisition investment, is that acquisition investment, you've got an existing asset, you've got occupancy, and you've got cash flow. And so for some folks, that's a real key factor. And as an observer of the investment marketplace and as a developer, I think people need to invest with what they're comfortable, what they know. The old Warren Buffett model, I'm only going to invest in businesses that I understand what the offer is. And people really need to stick to that if that's what they're comfortable with. But I also, as we suggested before, those good value assets are becoming more and more difficult to find. So that's the first reason that people would look at development. Why would I? Is because basically there's going to be available and additional offers of investment that you may not have otherwise. So let's say you've picked a specific geographic market to invest in. You go, look, I'm an investor. I love, Jacksonville, Florida. I'm just making up a name here. And you go in there and you're looking for offers, and you may say, look, I can't find enough of the right kind of offers to then have a competitive choice of investments and with the right locations and the right mix and the right sponsor and the right returns, all that kind of stuff, timing. And so looking at the development marketplace allows you to expand the opportunities of investment. I'm not saying there will be a fit for you. You just you want, as an investor, the broadest set of choices of investments that you can get. That's what a good investor does, is seek those out. So that's number one. Number two is really when the pandemic came, we knew it worked because we had already done several projects pre-pandemic going back 4 or 5 years. We produced returns. We knew the model worked in California, supply constrained, middle-income families, multi-generational families were under pressure. That's a peak market narrative, right? The market's really hot. Housing prices are high. It's very competitive. So we were the affordable offer, meaning this is a unit type that people could afford more affordably given their incomes for housing and new housing particularly. When the pandemic came, it was interesting because I go, oh, this is the time. This is my narrative for myself. This is the time that investors will switch gears and they'll start to look for distressed assets. We were all around for the 2008 GFC, as people call it now. And they would be correct. Generally, most recessions do produce distressed assets. It's just in this recession, that doesn't seem to be the case. We're a year, relatively so, year and a few months into the reality of it. And yes, multifamily in particular, which is our domain of expertise, did have its pressure and does have eviction moratoriums. And I do believe we'll see fallout. But here's the reality is there's so much available capital seeking deals still. Yes, there's a period from, let's say, March of last year through maybe August, roughly, where everybody took a breather and said, okay, we're going to not do deals. We got to see what goes on. But people came back, and we're in our own environment, we're seeing higher valuations in our completed assets than we did pre-pandemic. And again, I think that speaks to the acceleration that I described before. So having said all that, basically you get the capability to build new housing that serves a specific part of the market that a value add deal wouldn't necessarily. And so what I mean by that is, let's say you find a distressed asset, right? And this is where this thinking came out. I go, oh, everybody's gonna look for distress, but you start to look at distress. Why is it distressed? What happened? There's a general economy, but was there some local, state, regional, city level issue that had it? And so we came up with these two distinctions. One was distress prone and one was distress resilient. Actually, it was distress resistant in the beginning, but then we came up with resilient as a different distinction. And we really started to map out the UTH offer as a recession resilient product versus your standard value add, which there's a lot of those deals. I would say there's a lot of those deals that people did late prior to the recession. They bought at a high value. We'd argue the market could turn down. So that's the weakest type of deal. You'd have new syndicators, new sponsors. Everybody's like piling into that market. That's why deals are so hard to find, because everybody's chasing them, right? So we came up with this idea, and it really has turned out to be true, that when you invest in our product particularly, but new development would give you the capability to design and build a product that moves away from distress-prone markets or product types or mixes and move to a gap on the marketplace that's not overly competed for. This is the big issue with real estate development. Why it has larger downturns is because, of course, the fundamental economic cycle. But usually the signal of that is that there's overbuilding, right? As you go up into the peak of the market, lots of capital, lots of demand, rising rents, rising values. Everybody piles in, and then all of a sudden the market drops off, and then there's a whole bunch of product like overhang. And then that's where you find out who's got the juice to sustain a downturn or not, like capital, meaning when I say juice. And so I'm thinking right now we're going to see more of that potentially in the value add market. But honestly, I'm not sitting here, it's going to go up forever. I'm the most jaded guy you'll ever meet. Like, I'm almost verging on paranoia about the economic cycles coming to get us. And I'm not like suffering over it. I'm just like vigilant is the word I use. Investing in new construction allows you to fill in gaps in the marketplace that are not highly competed for, versus if you're buying a product that has a bunch of one bedrooms and it's in a distressed asset and the entire market happens to be predominated by one bedroom units. Guess what? There's maybe some logic besides the fundamental economic cycle why this thing was distress prone. And then you're in the story of the future. How does it perform? If I'm having to compete against all the other one bedrooms, how do I differentiate? How do I compete in that market? When I build a 5-bedroom unit in a marketplace, there's no competition. And so new development allows that. And then I'll finish the last one, which is a little bit easier. Like, you're buying a brand new asset. Your value add is going to be like, there will be some older product. Maybe it's newer, maybe it's older, but we're delivering units that have never been lived in before, that have the newest systems, the newest finishes. We build all of our units with quartz countertops, which looks amazing, highly differentiated from granite, happens to be price comparable, at least it was in the last couple of projects. That may change in the future. So we can address parts of the marketplace to attract new tenants. And you can do quartz countertops and value add. So don't get me wrong, but you're usually, if you're doing good value add, you're not replacing electrical systems. Maybe you're doing some plumbing. If you're having to do system-wide both structural, actual structure changes and or system structural, like mechanical, electrical, plumbing, then you're probably going to spend a lot of money. You are going to spend a lot of money. Let me rephrase. For us, we have that's baked into the cake already. Brand new systems latest technologies. We're now starting to pre-wire all of our buildings for Ethernet. We have solar. Some of this is mandated by the state of California. Some is our choice. We have private water meters for all of our units, so we can track the water usage and build a tenant through a billing system for their actual water usage. So there's a lot of things that we can do in a new construction environment that older value add deal, you wouldn't choose to incur the costs. It's not like you couldn't do any of those things, but to retrofit a building versus build it new is different. Now, people say you build a more expensive building, they're right, but we get rents that are commensurate with that expensiveness, and our rents are more than making up for the cost. And that's all about how much revenue you produce as a function of the dollar that you spend to produce it. And as long as that ratio is 5 to 7% NOI to cost, then you're in the right zone, and that's right where we are.
Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. I agree with you. I think that, as we were talking before we came on air, it's becoming a much, much more competitive market, and it's difficult to find value add properties. Cap rates are suppressing and the prices are continuing to go up. So there are opportunities, but as those cap rates are suppressing, also those cash on cash returns are going to suppress. If you want cash flow, you're just going to have to be satisfied with a lower return in this particular environment.
Or hunt harder for the diamond.
It makes no sense, though. From what I've heard, 30 to 34% of small businesses are permanently closing their doors, and yet the stock market continues to go up and cap rates go down and prices continue to go up. It just is not making any sense at all. So I'm not making any predictions. I have no idea.
All money, Alan, is inflating assets across the board. In fact, I'll share with your audience and you, there's something called the Cantillon effect. And basically the idea is, it was Richard Cantillon, basically when stimulus is inserted into an economy first via fiat money printing, the money first goes to asset holders, right? And so asset values increase before and real inflation in the economy starts when the money starts to filter through to the people who actually spend it. Obviously, your asset holders spend it, but not as much as your middle income marketplace. Like the middle class is going to be where your big spending is. So we're in the midst of deeply unusual changes like we've never seen before. I'm agnostic about this, right? Like we benefit because asset values go up for multifamily also. Rents go up, but also construction costs are going up. Lumber went from, when we spoke last year, it was probably $300 per 1,000 board feet. It's now, depending on what day you look, between $1,100 and $1,400 per 1,000 board feet. So whatever that math is, 5 or 6 times. And lumber is having supply constraints. So that's, maybe people say that's a bad example, but copper is going up, steel is going up, oil is going up. I think anybody who buys food at the supermarket these days knows that inflation is in that part of the economy. It's not showing up in the government's measurement of CPI though.
All those are good things for developers. Quickly here, just share with us, what are the risks to investors in development?
I think it's all the normal risks that you would see in any investment in multifamily. In fact, I use a system I used to call it the 3-bucket system. I didn't call it the 3-pillar system. And what this is, the 3-pillar system is like the place where we can show the combination of skills, actions, and risks between multifamily investment and multifamily development. So pillar 1 is your underwriting of the market generally. So think larger economic trends, but also local market trends. What's your rent? What's your 1-bedroom rent? How do you compete with that? How do you underwrite that? How do you underwrite the apartment market generally, and your deal specifically, operating expenses, et cetera? We do that as a developer, and investors who buy value add, they do that too. We do that similarly. Pillar number 2 is the main differentiator, and that's where the development skill set really comes into play, where you're checking zoning, you're buying empty land, you're hiring architects to design whole projects, you're making assessments of, do I do a 1-bedroom or a 5-bedroom, right? Like you're doing some like creative thinking and design in that space. And that's also usually the one that most people have never, like most people don't deal with zoning. Like they know the zoning of their house or their apartments, but they're not like changing zoning. They're not making assessments of projects based on what the zoning could build and what it can't build, that kind of thing. And then the third one is, the third pillar is basically your asset value. And that could be either in a sale or an appraiser. Right at the end of the day, whether you're a value add investor or a development investor, you want a more valuable asset at the end of the day versus when you started it. So buy low, sell high, right? So for a value add, you're going to buy a distressed asset or something below market because it's got some issues or the economy's down, and you can buy it really below replacement cost or buy it at lower than its value. Development is the same thing. In fact, my terminology is development's just the most extreme version of value add, because we take an empty piece of land and we add value to it by building a new building and renting it. So it ends up being the same thing. So why I put it that way is because pillar 1 and pillar 3 have the same risk between either domain, right? Investment or development, as an investor and a sponsor or developer. It's the middle one where the real differentiation of risk comes up for people who are looking at that space and go, hey, I'm going to be a developer, or I want to invest in development projects. So things like constructing the new building, right? You have a higher level of construction risk, right? Because you're taking raw land and turning it into a brand new building versus your value add deal where you've got an existing asset and you're doing carpet and paint and cabinets and appliances, right? That's an easier type of thing. You've got the zoning risk. So we talked about this before. We don't rezone properties generally. It's not to say we never, but if we have a choice, we never do. And so you might invest in a deal where the developer's got to get a zone change and that doesn't happen, or they get a no vote at the city council and they lose, right? Third would be like where we talked about the inserting a new product type into a market that hasn't had that before. So some people get comfort. They go, oh, I'm going to buy a building full of 1-bedrooms because there's a lot of 1-bedrooms. And so that to them is a signal of strength or probability of success. I think to me, it's higher competition, but there is a certain component part of experimentation, right? Like when we develop 5-bedrooms, it's not like nobody had ever done 5 bedrooms before. Some people have, but not at institutional scale in the real estate development space. So we had to start small and experiment, right? So the introduction of new ideas, new product categories, product types, trying to serve unusual or underserved parts of the marketplace, that's a risk. Let's see. So I think those are probably the main ones that I think of. I think maybe there's I don't know if there's a sponsor risk. I think sponsor risk exists whether you're an investor investing in sponsored acquisition rehab, or if you're investing in sponsor as a developer. Although I would say you as an investor need to vet your sponsor developer better, because there's more challenging things to do, which is pillar 2, right? You better make sure that investment and that sponsor resolves those issues pre your investment, or you have a good story and can see demonstrated expertise from that sponsor that they really know how to do it. And usually demonstrated expertise shows up in like, I got deals done. I completed them and I leased them up. I leased them up at a high rate, at above market or above pro forma. I sold it for a higher value than I built it. You've got to produce a value more than it costs to build the project. So you want to assess those accomplishments, right? Like real data. And I think that's true of investing in any deal. So I don't mean to say it's just for development, but there's like a larger skill set needed for a sponsor in the development space than you would have in the investment space.
Right. Thank you for sharing those, Scott. Before we go into our last segment here, you were talking to me before we started out the show here about the Academy for Developers. Talk to us about the Academy.
Yeah. So actually, perfect. So the 3-pillar system I came up with as I started to talk to people, particularly like it on shows like yours, where like people are like in the investment space and they're thinking about the development model and, hey, do I go there? I had a great conversation with Michael Blanc. I was on his podcast. And when we ended the show, Michael's not a developer and he'd be the first to tell you that. You know, he goes, Scott, he goes, that's great. You're doing that. I've thought about development, man, but that scares me to death is more or less what he said. I'm probably not getting his words exactly correct, but he, like rightly so, said that's a different domain. Like he was clear on where he had knowledge and where he could operate effectively and with competence and a lot of knowledge to be able to execute correctly. And there was like a recognition of like he wanted to go there, didn't have a clear understanding of how it worked. And right when that was like, risky. But I see a lot of people who say, hey, look, we're investors, so we must be able to do that. Like, we know how to do deals, right? Like, how much harder can it be? But it really is vastly different. So out of all this came the idea of what I'm calling the Real Estate Developer Academy and the Real Estate Developer Masterclass. And this is going to be really 3 different offers that we make through my personal website, which should be up and running by the time that your podcast airs, which is under my scottchoppin.com. That'll be my personal branded website. And we're basically going to have 3 offers eventually, and we're going to be building them over the next several months. The first one is going to be an online course, several modules of learning, predominantly video, written articles of some files like pro formas and stuff that we'll share with people, that when people would go through this series of courses, they could come out at the end of the day and know pillar 2 really well. In fact, we'll do it. You could start from scratch and never have done any real estate investment. We'll show people how to underwrite apartments, how to assess the market, how to do all the pillar 2 things, construction design, hiring architects, zoning if they want to do that kind of thing. And then, of course, pillar 3, selling and producing profits. So the online course will be available probably within the next several months. And then the second offer is we're going to have a series of ebooks that basically produce the same sort of like information, but it's obviously in a ebook format. But basically, we're going to have several offers where people can buy ebooks. Hey, you want to understand how to do the land acquisition process in real estate development? You can buy this ebook. You want to understand how to underwrite apartments? You can buy that ebook. And then actually we're going to have an offer where we put the whole series of all these different things together in what we call the Real Estate Developers Playbook, which will be available on my website, scottchoppin.com. And that you could buy that thing. And basically that would be a written version of like pretty much doing the entire process. It won't be as robust as the online courses, but certainly anybody who's sophisticated and particularly seasoned investors would be able to read through that and be relatively competent to operate. And then the third offer we're going to make, which is actually an offer that we have that's ongoing now, is basically myself and Urban Pacific be available as advisors to people who are interested in moving into the real estate development space or who need to do development and aren't developers themselves, or people who are investors who want to move into the development space but need resume and knowledge and track record to supplement their own offer. We do bring capital when it's appropriate. We can make introductions to lenders, and we have several clients right now that are active under that offer. So that one actually already exists and is in place now. But when people go to the website, scottchoppin.com, they'll see certainly the ebook and the advisory offer will be active by the time this is up in June.
Let's go into our last segment here, and let's take you back to the personal aspect of your life and share with us one of the most challenging experiences and setbacks from your life, and how did you come through that time, and what did you learn from that?
Yeah. So I mentioned it before, but as a real estate developer, went through the 2008 downturn. And that was like I won't even say it's a classic downturn. It was the most robust real estate centric recession that we had seen probably since the 30s. And so at the time we've always developed urban infill assets that in the name of the company is Urban Pacific. We formed it in 2000 specifically to pursue infill urban development. And we had 3 or 4 very significant projects that were right on the margin in this 2005, 6, 7, and 8 era. So we were challenged with saving those projects as best that they could be saved in that environment. And we had a lot of exposure to the for sale market. We were doing a lot of urban in the city condo, like for sale units. But in that case, we were doing in that period of time, very little rental. And that was the only time I'd ever done that, Alan. And actually, we'll never do that again. We're going to stick with rentals. This is what we know best. And so I think that the lessons learned were this. One is the pressure to try to save deals is incredible. Some deals can be saved and some can't. And I think where that shows up for developers and sponsors when that arrives, which that time always will arrive. And I'm not saying it to be fatalistic. What I'm saying is that the economic cycle is very fundamental. It's always going to be there, right? It's always up and down and up and down. And we as sponsors, investors, and developers shouldn't be our moods shouldn't necessarily be influenced in a vast way and our actions by the cycle in the normal way. Like, in other words, when a downturn, everybody's in a bad mood, and a peak, everybody's frothy, and that we experienced that. And so it really taught me to be able to manage my psychology, like the pressure. We ended up basically saving most of our deals. It wasn't pretty, but we got through it and we stuck around. I had several people that I knew that are not necessarily close colleagues, but people I heard about through people that I was working with in that period of time that basically just left town. And so one of the things is stick around. It's hard. It's hard as hell, I will say. And it's like, I got a lot of gray hair here from that. But I think it really shows up for people, whoever is involved in the deals, people around you, to be able to maintain your like ethical standards for yourself and people that are around you, to say, look, well, I went through that and I got we all got like our asses kicked. I don't know a single person who wasn't deeply affected by that. But what the difference was is how differently people acted, either positive or negative ways. What's the old saying? It's not the event that is the make or break. It's how your reaction to the event. That's exactly right. And so that's number one, right? Stick around. Number two is to like not ignore the cycle, right? Like part of what I observed in the 2000 internet recession in 2008 is particularly the media, which is even worse today than it was, of just like latching on to somebody's story about the economic cycle and writing that to death. So what I remember, in fact, I keep on my desk it's like a booklet, like a comb bound little booklet. And it's multiple articles that I clipped during that period that were all signals in the media, signals in the information flow, signals in the noise that preceded the recession. And had I listened to them and took action to change our deals up, we would have been in a totally different situation that we were. But I remember seeing them, and because there was so much noise, and I call it signal from the noise, you need to find that key person or that key company or key report, to extract it out of all the noise in the background. So one of the ones was Tom Barrack, right? Colony Capital. And in 2005, he was on the cover, I think it was either Forbes or Fortune magazine. And it's him. And if anybody knows Tom Barrack, he's got his shaved head. And he's like, I'm getting out of real estate. And I remember seeing that. And at the time, I was like, it seems like it's going so good. And prices are going up. And my gosh, we got financing and we got capital and we got buyers. I don't know how this could be any different than what I'm seeing. And like my story, what I saw locally in our markets and our deals is much different than what Tom Barrack was saying in a national platform. But looking back on it, that he was right on the money, man. He sold at the perfect time, maybe a year too early. But you look back on it and it was like magical. Like you go, wow. And in fact, when the pandemic came, I was signed up for everybody's email lists and Walker and Dunlop and CBRE Capital Markets and I don't know, Yardi and everybody, man. And still get all that stuff. I get all those reports. And we were getting a lot of those before, but I really wanted to see how everybody else was reacting to the market. And Tom Barrack was one of the people I paid most attention to, as you'd guess. So the lesson is to basically ahead of the down cycle, because the down cycles are what, if you're exposed in the real estate market, that's where they're going to get you. Like you invested at the peak or going up to the peak, and then you got to ride the trough down, is to get yourself a cadre of like economic prognosticators, people who observe the market and speak out publicly. And particularly what I spent a lot of time doing is vetting those sources as people that don't have some agenda other than the actual realistic information. And so there's a couple that I'll share with you. One is a blog called calculatedriskblog.com. It's written by a guy named Bill McBride. And he started writing the blog with another writer in 2005, 2006, totally called the CDO bad mortgage market like years before. And I didn't get a hold of his blog until post 2008. So it's like too late for me. But he's not an economist. He's like a retired Fortune 500 executive. He talks about lots of different economic indicators, but he's got this sort of focus on housing that I really appreciate. He does killer graphs. He does tracking of permit issuances and housing prices, and he graphs them over time. So if you follow along his blog, you can see the ups and downs in the graphs yourself. And for me, I'm a very visual person. You can start to compare it. Hey, where are we with 2008? Where are we with 2000, 1989, those kind of things. He called the 2007, 2008 recession. He also called the bottom in 2010, 2011. I can't remember what the last time I've seen him. He's talking about the eviction moratorium and those kind of things. But I don't sense that he's particularly negative on the housing market per se. So that's one. And then the other one is a website called econpie.com. And they have something in there called the bar grid analysis. And basically what they've done is they've taken 25 to 30 economic variables, all the stuff you normally hear, permit issuances, consumer confidence, your manufacturing, all kinds of different, it's like the total big picture of all the economic variables. And if you tracked any one of them, you might get a little off signal, right? Oh, that one's up, but this other one's. And what they do is they combine these together in a format that they can track those variables on a graph. It's a 4-quadrant graph, and it's basically a graph of the economic cycle, right? So we go from expansion to peak to decline to recovery, and it basically is the economic cycle in a graph, and they shows these variables moving around the graph and each in their own positions. Maybe permits is bullish and it's expansion, but consumer confidence is bad, so it's in the recession category. I'm being extreme here. And then what they do is they do a mean of coordinates, or MOC, which basically is the mean of all these different variables in one dot on the graph. And then that's the focus of it. And then that goes around with all the other different ones. That's been a really interesting one to observe, because basically you can get a total picture of the economic environment without necessarily going down a rabbit hole on building permits. Like building permits is a big one in the housing industry, and you can be fooled by that, right? Months of supply on the market, like these are Bill McBride ones. And so I use these two together. And the key about these is that they neither have any agenda for selling a book or getting you to buy gold. So if you look to some of the gold bugs, the world's going to end like every day, man. Those gold guys, like the world's going to be ending tomorrow. And so I really look for people that, like, as best I can tell from the information that I can get on the internet and publicly, that these people don't have an axe to grind, or they don't have something that's influencing the way that they would. I'm a stock analyst, and benefit me for like people to buy the stock that I cover. That's a bias, and I don't want biases. There's no zero bias out there, by the way, but there are people that are much, much lower biased. So in fact, if people want, they can go on our website, www.pacific.com. There's a red button on every page that says sign up. And if you want to get on our Saturday email blast, I basically put together a 4-article email every Saturday, and I will basically capture all these things that I'm reading, different readings of economic indicators. Maybe we'll screenshot the bar grid. We'll get articles from every source that we can, big and small, real estate, non-real estate, some like larger trends, some medium and small trends. But if you want to see what we're seeing and what we're observing, get on that Saturday email list, and we share that out on a weekly basis.
Excellent information. Let's go to our last question here. And imagine that you've come to the end of your life, and as you lay on your deathbed, what do you look back on as your greatest joy and sense of fulfillment?
It's going to be my family, Alan. Really, at the end of the day, my family. So my wife, Becky, and I have 3 kids, 19, 17, and 13, Sean, Patrick, Dylan, and Jenna. They're what I work for. It's the most important thing I've ever done. It's the most valuable thing that I've ever done in my entire life. And that's why I go to work every day. And I love the idea of building a business and being successful that way. But the purpose, the existential meaning of that is to take care of my family, to help my family to grow and be successful in their own. So if I did that, or when I do that, will be what I look back in that situation that you described.
Scott, it has been a pleasure once again. Thank you for being on the show today.
Great to be here with you, Alan. Appreciate the invite.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.